Greetings and salutations. All right, my friend.
Greetings and salutations, sir. How are you?
What is now C for Chris, or you just go by C Hill or what?
First name is Caesar.
Caesar. Oh, I like it, man.
Yeah, like Julius
That's pretty
Caesar.
cool, man. Might scare
Yeah,
some people, like, oh,
right.
I
My
came,
mom
I
had high
saw, I
hopes.
conquered.
Exactly. Et tu,
uh,
Brute.
yeah, but I think we did land Vindi, something like that. I think.
Right. Yeah, something
All
like that.
right. So you wanted to talk about variable annuities and retirement plans.
Correct. Yes, sir.
Okay. And you're taking your
Series
Series
seven.
7.
Correct.
All right. Can you see my screen?
Yes.
Let me get rid of that. Variable annuities. Now, what I think is not testable, but I think of a variable annuity as a mutual fund with an insurance wrapper. Don't ever
Correct.
tell a compliance officer that because they'll freak out.
Right.
Say, hey, listen, Caesar, do you own mutual funds? And you say, yeah. I say, do you own the old kind or the new kind? And you go, what do you mean? I say, well, in the mutual fund that you're in, do you get distributions and you have to pay taxes on them? And he said, well, no, I don't get the distributions because I tell them to reinvest the money because I don't need it right now. I said, well, regardless whether you do that or not, you're getting a 1099 and you owe taxes on that because you're getting constructive receipt. This mutual fund has an insurance wrapper. And so you're never going to get constructive receipt. Now you say, what's that mean? You're telling me I have to reinvest? I go, yes, you must reinvest into the mutual fund, the separate account.
Right.
You say, well, that sounds like a bad thing. I go, no, it's a good thing because that means you don't get any constructive receipt. So that money is going to, grow tax deferred for you. Now, fixed annuities are different, right? So, I say, what's the difference between a banking product and an insurance product? So I say in a fixed annuity, I say, Caesar, if you give us $100,000 for a fixed annuity, we're going to take that $100,000, we're going to put it in the general account of the insurance company and we're going to invest it. And we hope to make more than the 5% we promised you. We're going to buy stocks and bonds and, real estate.
Okay.
We'll be an insurance company long if we can't make more than you we're going to pay you, but not your problem. In an insurance product, fixed annuity or banking product, the financial institution is assuming the risk. And so, maybe you get upset. You go, I forget what you've been doing, man. You've been investing that money and making more than you promised me. I said, well,
Right.
I
Right.
never misled you about that. Are you willing, test question number one, to assume the investment risk? In a variable annuity, the customer is assuming the investment risk because he's putting the money into a separate account. So as I said, fixed annuities are not securities because you can't lose any money, right? I mean, in
Right.
securities, your capital's at risk. Premiums are placed in the general account. You get a guaranteed, boy. If you want to hear the word guarantee, you need to talk to a banker or an insurance agent.
Correct.
Because in the securities industry, there are no guarantees.
Right.
Investment risk is assumed by the insurance company. Now, the good thing about insurance is that, if you have an annuity and you annuitize and turn it into an income stream, it'll pay you for your entire life. And you may live beyond the actuarial table. So that's a neat thing. You're going to have a monthly check forever. Now, the law of averages says large numbers that insurance work on say, well, some people will die tomorrow, some people will die 30 years, but it'll all work out. Now, in a variable annuity, we're using after tax money you've already paid taxes on.
Mhm.
So let's assume you've maxed out all your other retirement plans. We've maxed all the things you have at your employer, all the things you can do in a qualified plan, because qualified for test purposes means we've met the qualifications of the Department of Labor and IRS, and we're using pre-tax money we've never paid taxes on, like your 401k is a qualified plan.
Right.
Money that's going in there has never had taxes paid on it.
Correct.
Here, we're taking money after tax. And so maybe you say, Dean, I would like to invest $100,000 into a variable annuity. So that is money that you have already paid taxes on. We're going to deposit that. And I say, which of these mutual funds would you like to pick? So the separate account is a mutual fund. Sub account, sometimes is what they say on the test. And the first test question, as we said, is in a variable annuity. The customer is assuming the investment risk because that separate account is a portfolio of securities. Now, I hate this because I'm prejudicial. I'll just tell you, I like stocks. I'm a bond guy.
Correct.
This has possible inflation, but that's only compared to the fixed annuity. So I kind of hate that question because in comparison to the fixed annuity, yes, but in comparison to other things we might offer you, no. Now, as I mentioned, if you annuitize this thing, that's where we're heading. If you annuitize, you might live longer than the actuarial tables say, but that's the risk the insurance company takes.
Correct.
Last question. You have to be duly registered to sell this. So you have to be registered to sell securities, the mutual fund, and you have to be registered to sell the insurance. If you're not duly registered, then you cannot sell this product. And the other test question that emanates from that is like, Caesar, you got your 6 or your 7, you got your insurance license, and I don't have that insurance license, and you do. Why don't you go give me your rep number? I'll put it on your rep number. We'll split commissions. And we never split commissions with people who aren't registered properly.
Right.
Now, one of the things you're going to get tested on is when we annuitize, how the check is going to go up or down based on the assumed interest rate. I'm going to show you that to you in a little bit.
Okay.
That's what happens when we actually, annuitize.
Real quick before you move on, Mr. Dean.
Sure.
When you say that a mutual fund is I should say a variable annuity is a mutual fund and a mutual fund wrapper, what do you mean when you say that?
What I mean by that is it's what the separate account is a mutual fund. So what you're buying are accumulation units, but it's the same thing as buying shares in a mutual fund. So if I'm your insurance guy, say, Caesar, you've accumulated with your $100,000, you bought, I'll just make up number 6,000 accumulation units.
Okay.
And that's just like shares in a mutual fund, because that's what that separate account is. It's a diversified portfolio of securities, professionally managed, right? So you're going to get diversification because there's more than one security in that separate account.
Right.
You're going to get professional management. There's a portfolio manager at this insurance company. And you're going to get ease of ownership because you're not, once you get it set it rolling, you're not going to have to do anything else.
Correct.
As you see here, I have a chart for you. Now, are you taking after your 7? Are you taking a 63? Or are you taking a 65 or 66?
66.
So I made a little note here that this is only a 65, 66 question.
Okay.
We have a type of annuity where it's called an equity index annuity. And it sounds like it's kind of a security, but it's actually not, because there's no way you can lose money. I say, Caesar, this is an equity index annuity, and we're going to pay you 80% of whatever the market does. Market goes up 100 grand, we're going to pay you 80 grand. And you say, well, the market goes down. I said, doesn't go down past 180. Once you get to your high water mark, you never go backwards. No negative reset is what they say. How we say it. Okay, so now I've got a nice little chart here because you brought this up. And we want to make sure we understand the distinction between using qualified money or not. So I told you that you gave me $100,000 after tax, but I probably should have done some better suitability. What I mean by that is I should have said, Caesar, are you an employee of a nonprofit or an educational institution? You say, well, that's an odd question.
Right.
You say, why are you asking that? I said, because if you are an employee of an educational institution, by the way, trick on the test, doesn't have to be the professor. It could be, the people in the cafeteria, the hospital. It doesn't have to be the doctor. It could be the nurses, whatever.
Right.
If you are allowed to have a variable annuity that is pre-tax, meaning you're going to be putting in money before it's had taxes paid on it. Now that means you're going to have a zero cost base and everything else is coming out. So, as we said, I got this little contrasting chart. In a regular annuity, we're talking about anyone is eligible. We're using after-tax money. Your cost basis that you put in is that 100,000. That's going to be important later. We said there's no constructive receipt, meaning you can't get this money out of there. If you do, by the way, it'll be a penalty, just like a retirement plan. It's tapped deferred growth, unlike, as we said, reinvesting in a mutual fund. DRIP stands for Dividend Reinvestment Program. And that's where you tell a mutual fund, I don't need the money, just buy me more fund shares. And the IRS says, we don't care if you tell them that or not, you owe taxes. Whereas in a TSA, we're using pre-tax money, and none of the money you're putting in there has been taxed. So, you're going to owe taxes on it. Now, the way to buy this, you can buy a single payment. So in my example, you did a single payment. You gave me 100 grand, end of story. And then we're going to hope it grows between now and when you're 59 and a half. Woo!
Correct.
So let's say, it's $1 million when you're 59 and a half.
Right.
And then we're going to turn it into annuity units. But you can also buy annuities that start paying you immediately. Those aren't the ones on the test. The one you're encountering on the test is the deferred version.
Okay.
You give me $100,000, we buy accumulation units, and then X number of years later, at 59 and a half, you don't have to take the money when you,
Right.
but you can. You can feed it if you want. So you call me up and you say, hey, Dean, I know I gave you 100. Can I throw another 50 in there? I go, absolutely. Absolutely. So you can make a periodic payment if you'd like. Now,
Hmm.
when you're buying these things, they're called accumulation units. And as I said, that's very intellectually similar to buying shares in a mutual fund.
Hmm.
You have a high cost structure here because you're paying for both the mutual fund part of the product as well as the insurance part of the product. So, there's contingent deferred sales charges, meaning that if you leave the money in there, we will not charge you.
Hmm.
But that again is, something that needs to be disclosed up front.
Right.
Listen, on the test, they are asking if anything should be reasonable and not excessive. You should say yes. I don't care what the question is. We should always be fair and reasonable.
Reasonable.
We should
Right.
never be unfair and
Right.
unreasonable, right? So
Right. Right.
expense structure, I said, has the expense structure of the insurance product and the expense structure of mutual funds. So what we're saying is these are expensive.
Mm.
They're
Right.
expensive. And again, that could be good or bad. It just is what it is.
Hmm.
All right. So now you're 59 and a half and you got $1 million in there. And
Ooh.
I say, what would you like to do? Would you like to do a lump sum? You want me to send you $1 million? Or would you like to turn this into an income stream that you can't outlive? And you say, well, Dean, I like that income stream idea. Sounds pretty good.
Right.
And you say, what would give me the largest monthly check? Test question. The thing that would give you the largest monthly check is if you tell us that you want us to pay you for your life and your life only.
Right.
Right. If you want me to pay your spouse, I had a client. I don't sell a lot of these because I'm not an annuity guy, but I had a client and when it came to annuitize, uh, he said, Dean, what if I want to pay my wife after me? And I said, well, Al, I mean, I'm not judgmental, but your wife is incredibly younger than you. And that's going to drop that check dramatically. I mean, because the insurance
Right.
company is looking at the actuarial tables and says, Al's going to be here X number of years, and if Al passes and then, your spouse, daughter's going to be here, who knows how many years.
Right.
By the way, it was a good choice. It took his check down from like 9 grand to 4 grand a month, but his spouse is still around and she's still collecting 4,000 a month and she'll collect 4,000 a month for the rest of her life. So,
Oh,
it was the
wow.
right choice. But the test question is what one gives the customer the biggest monthly check?
Life only.
Now, well, yeah. Now, once you start getting that check, we got to talk about what happens there. So, as I said, the separate account is a mutual fund. So every time you hear the word separate account, if you just in your own mind said mutual fund, you would get nothing wrong.
Mm.
And every time you hear the word accumulation units, you just shed shares in the fund, you'd be fine.
Right.
Here I'm telling you that its valuation is similar to mutual fund, but it's actually the same. So one of your test questions is a mutual fund. Let's try this. A lot of times variable annuity questions are camouflaged mutual fund questions. So
Mm.
for example, under the Investment Company Act of 1940, we need to calculate our NAV, our net asset value, every business day.
Correct.
So how often does an insurance company have to calculate the valuation of an accumulation unit? Every business day.
Right. Daily.
So it's very, very similar, right?
Mm.
To start a mutual fund, we need 100 shareholders and 100 grand. So we got to start a separate account. We need 100 shareholders. We need 100 grand. Same
Mm.
stuff.
Okay.
Now, as I said, when you want to pay it out, you can say, Dean, send me a check, or you can do a lump sum. If you want to turn this into a check, what we're going to do now is, from accounting perspective, is turn your accumulation units into annuity units. So I say, hey, Caesar, you have X number of accumulation units, but now that you're annuitizing, those are going to be annuity units. And you say, well, what's my payout depend on? I said, well, your sex, the insurance company pays the guys more because we die sooner.
Correct.
Ladies get paid less because of the actuarial tables. The amount of money, I just told you, we're going to assume there's $1 million in there.
All
And if
right.
it was 10 million, you'd get more money, right? The more that's in that separate account, the more you're going to get. Your
Correct.
age, if you wait till annuitize, if you're 59 and a half and you wait till maybe you're 70, you'd get a huge bigger check,
Mm.
right? Because they think, okay, we're not going to have to pay you as much.
Right.
The payout option you select. And then, as we said, the return of the sub account, the mutual fund, the separate account or sub account.
Correct.
All right. So I say, listen, I want you to give me a call when you get your first check. So you've decided you're not taking the lump sum. You've decided you're going to take the monthly check. And I've told you to give me a call when you get the check. You say, Dean, I just got my first check, and my first check is $1,000.
Right.
I said, okay. I say, now, Caesar, your next monthly check is either to be more than 1,000, the same as 1,000, or less than 1,000. I don't want to cloud your mind, but we have what's called the assumed interest rate, the AIR.
Mm.
And if
Right.
we do better than the AIR, your check is going to go up. If we do less than the AIR, your check is going to go down. You say, well, I think I get that. I said, well, no, I tell you what, my clients have never got this until we have 3, 4 checks under our belt.
Correct.
So I want you to call me when you get next month's check. This month's check is $1,000. Next month's check is either going to be more than 1,000, or less than 1,000. So you call me, and let's just say, you say, well, Dean, what is the assumed interest rate? I say, I don't want to tell you because it will just cloud your mind and it doesn't matter. You say, well, damn it, Dean, I want to know. I say, okay, well, I'll tell you, but it really has nothing to do with this. We'll just assume the AIR is 4%.
All right.
So you call me and you say, Dean, I got 1,020. 1,020. You got $20 more. It doesn't matter if it's 10 or 15 or 20, it doesn't matter, more.
Right.
So I said, well, that means, Caesar, we got more than 4. You said, well, how much more than 4? I said, it doesn't matter. I don't want to tell you because it would just cloud your mind. It doesn't matter. It doesn't matter if this is 4.1 or 20%. Doesn't matter.
Right.
It's still only going to go up $20 in this example. You said, well, damn it, I want to know. I said, okay, I'm going to regret it, but I'm going to tell you, we got 6%.
Right.
He said, Dane, I love this. I go, well, call me again because, people don't get it. And this is what you got to be able to do on the test, by the way, is tell the customer what's going on with the check.
Right.
So you call me, Dean, I just got my third check. And it was 1,020. I said, okay, well, you got 1,020 and you're on your second check, you got 1,020 this time. So that means we got the AIR, the assumed interest rate. You go, what was that again? I said, I don't want to tell you because it would just cloud your mind. That's 4%. So we got 4%. You said, well, I got it. I said, no. I've had my clients, they only get it when the check goes down. So, we'll stop this conversation monthly when you have a check that goes down. So next month, check number 4 is 1,040. You go, wow, we got better than here. I said, you're getting the hang of it. You go, how much more? I go, it does not matter.
Right.
And I say, it was 4.1. Doesn't matter.
Right.
And you say, wow, I love this. I go, well, it's called the law of large numbers averages. I say, listen, we're still going to have the conversation because so far everything's going your way. So check was 1,040. I'm not going to take you from 1,040 like $50. We're going to bounce you around a little bit because you're in retirement. You call me, you say, Dean, man, the check was 1,020, went down. And I said, well, Caesar, that means we got less than the AIR, the 4%. Now be careful. You go, well, how much less? It does not matter.
Right.
I said, listen, we had positive performance of 3, but 3 is less than 4, so check goes down. So that's what you got to be able to do on the test, is this idea of what the check's going to happen to the check if they annuitize based on the AIR,
Right.
All right. So now, as we said, the other thing you can do is you can take a lump sum. So as I said here, you would now have $1 million. You're 59 and a half, there's $1 million in there.
Right.
And you say, Dean, send me the $1 million. I say, Caesar, if I send you that $1 million, you're going to owe ordinary income tax rates on $900,000.
Correct.
Because remember, you paid taxes on 100 already.
Right. That was my
You say,
cost
man,
basis.
you never told me that. I go, my bad. I should have told you that. Because, if you did like some other investment, you could have qualified for long-term capital gains.
Right.
Right. You say, well, Dean, I got it. No. Don't give me a lump sum. I want to do a random withdrawal. Send me my 100. Very testable. If I send you a random withdrawal, the IRS is going to say LIFO. So whenever you get a tax question, if you're not sure what to answer what yields the most to the U.S. Treasury.
Right. Last in, first out.
So yeah, if I send you 100 grand, that's 100,000 of the 900,000 that you have not paid taxes on.
Right.
Now, the first thing you want to do as a test taker is put all of this in your brain housing group and then work on delineating it. And so there are other questions that have LIFO and FIFO. For example, if you've been dollar cost averaging in a mutual fund and you go to sell securities, you could do share identification. You can do average cost, but if you can't identify your shares, the IRS is going to impose upon you FIFO. The first shares you bought in the mutual fund are the first shares you're selling, because again, that would generate the bigger tax. So what a variable annuity, what generates the bigger tax is LIFO, last in, first out, and in dollar cost averaging, what generates the bigger tax is FIFO. So as I always say, RTFQ, make sure you're reading the question.
Right.
Now, the other time this shows up, one more test scenario, and it's not about taxes. It's about the exercise of an option. And so the OCC, the Options Clearing Corporation, does that randomly.
Correct.
But within the client base, we can do it random, FIFO, or another fair method. So we can do the first person who wrote the option contract is the first person who gets exercised. So those are where those come up in terms of your exam.
Oh, you talking about at the broker dealer when you say client?
Yeah, the broker dealer, remember, receives the exercise notice from the OCC.
Right.
Merrill says, why us? They said, why not? It's randomly. And then Merrill within its client base has more than one customer who short that particular option. And so we're trying to decide which one of our Merrill customers is going to have to deliver the stock or the money.
Uh-huh.
Now, and in the test, you got to believe in human depravity and original sin. And then what I would like to do is be discriminatory and go, oh man, I don't want to do to Caesar. Caesar, give me a gotcha. Right. So whatever method we are using, we have to tell our customers in the OCC, can't be making it up on the fly, how we're going to do this. And then if we change it, we got to tell everybody that we're changing it.
Correct.
Because otherwise we'd be going, I'll keep doing it over and over again. So I told you, LIFO is very testable. If you get the money before you're the proper age, it's like a retirement plan. This is called a non-qualified retirement plan. Non-qualified, because we're not meeting the Department of Labor, we're not meeting ERISA requirements. Who cares? As a test taker, the only part we care about that is that means we're using after-tax money. Now that check I sent you $1,000. And remember, you put in 100 and now you got $1 million.
Right.
And you said, well, Dean, that monthly check isn't part of that, my own money coming back to me? I say it is. 10% of that $1,000 is not taxed. 10% of the check, because remember, it was 100 and now it's $1 million.
Right.
So that 10% is your own money coming back to you. So that's called the exclusion ratio. I'm not going to make you do any math on that. Just a general understanding that, you're going to, have partially not taxed on that. If you die, annuity death benefits during the accumulation period, the annuity is included in the value of your estate, and the proceeds to your beneficiary in excess of your cost base are going to be taxable as income to them. So I don't think that's a big test deal. Some things on the test are high probability and some things are low probability. That's low probability.
Right.
Suitability is huge. Heightened suitability. All the guys I know who sell these tell me that on their investment platform, if they put any other investment, it typically just goes through in the investment do. And they go to put in one of these, they tell me it locks up.
Right.
It's all compliance. So you want to make sure it's suitable. So as I said, suitability is always big on the test. And suitability is almost always judgment questions where you got to look at the question. So as I started this conversation by saying, have you taken care of all the other things available to you? Because if you can use pre-tax money through your employer or through your spouse, or fund your IRA, that's tax advantage is going to be better than this. So after you've taken all of that and you still want to save, then maybe this is something to consider. I've been informed you of all the various features and that you would benefit from them. So what we're trying to say there is you shouldn't be doing this because of the commissions involved. You're doing it because it can help the customer, right?
Yeah.
And you got to look at it as a whole in terms of being suitability. That's called know your customer. All right. Well, that was about 30 minutes. We ran pretty quick there to get that done in the time allocated for the coaching call. In terms of your other things about retirement plans, a lot of that